The last 48 hours have been a complete bloodbath. Tech is crashing, AI stocks are bleeding, social media is screaming, just sell everything, get out of the market. And if you're feeling anxious right now, you're not crazy. But the problem is this: most of what you're hearing about the sell-off is flat wrong. In this video, I'm going to break down exactly what's happening in the market, why software and AI are getting crushed, what's next, and what is the most important thing you can do to protect and manage your portfolio in this volatility. My name is Jonathan Little. I record videos just like this for people just like you, average investors, people to better your portfolio and make some sweet, juicy premium and gains. You could watch hours and hours of TV on Fox News, and most of those experts seemingly don't have an idea of what's exactly going on. So today we're going to break it down. Let's pop over to the iPad here. Just like you can see, the tech and the software sell-off is pretty large. Palantir, we have 23% drop in a day. Tesla, 13%. NVIDIA, 8% drop. So why exactly is this happening? So we're going to dive into that right away. But I will say, don't panic. Take a deep breath, and I will go through the stats and the numbers, hopefully help you feel a little bit more comfortable on what is happening in the market. Okay, so why is this happening? Here's my take. A little bit scary. There's a little bit of a new platform that is taking over that scare that's causing the AI to feel like it's going to take over all the jobs and all the market gains from your position. And then it also goes into service scare. People feeling like they won't have a job in the future. And I'll talk about that in a little bit here. And then also trimming of the profits. So over the past couple years, obviously since 2022 mainly, we've seen fantastic gains in positions in tech mainly, some massive run-ups, absolutely massive. And we'll go through the stats here in a second. But when it comes to profits, investors know that you can't just hold the bag forever. Okay? You have to trim the dead branches on the tree. If your portfolio is a tree, you have to keep it healthy and little by little trim the good positions for profits and trim the bad. It's not a terrible thing if you're in a loss on a position. You could tax loss harvest those losses. Okay. The next piece is if it's a good company, then buy more. If a great company has an upward trajectory and you're worried that this dip right here, you're super worried about it, does it mean it's a bad company? Not at all. This is normal volatility in the market. But if it's more of a company that's like this, and then it's on a severe downtrend, then that's when you'd consider just taking a loss here, and then maybe purchasing more of shares in a company such as that. So let's go through that. Let's say we're doing an analysis on Apple, which we all know Apple, hopefully, pretty popular company if you don't know them. Let's say there's two people. We have Bob and we have Bill. So Bob and Bill both bought shares at $100. Let's say this was back in 2022. Since then, the $100 is now $200 per share, and then also $200 per share over here. Okay. They're both dollar cost averaging. They both feel like they've done good and they're just kind of investing every single month. Let's just say Bob decides to keep investing over the long run and keep buying every single week. But then Bill, he kind of gets scared. And as the company's going up, every time there's a drop and then he sells. Who do you think is going to be more successful in the long run? Probably not Bill. It's probably going to be Bob. Bob's going to be more successful. So when we hit these little bumps in the market where, even if we go back to our first page here, where Palantir had a 23% drop, Tesla 13%, NVIDIA 8%, that sounds really scary, but in the grand scheme of it, looking back at our chart here, is it really that scary? If it starts rebounding, going up, and then you recover back to where you were. And so this is more of the DCA approach that we talk about here on the channel, and that really benefits people in the long run. Okay, looking at that similar thing, not all growth is a straight line. So now that we go back to the companies that we're looking at, NVIDIA, Palantir, forget the other one we're looking at, and Tesla. Do you think that these are companies that are bad and are going to go bankrupt? Or do you think that these are companies with really good growth potential and they're just going through normal weathering of a storm? Maybe some news that freak people out, maybe some profit trimming or just a devaluation of the dollar and stocks rising in accordance to that. And so we have to look at over a 10-year mindset. And if we were to look at this in terms of an Apple projection, if it was to average 10% a year, which we all know it's averaged more than that, does this accurately describe a stock? It's going to go up 5% and then it's going to go back up. And this time it's going to go up, let's just say 13%. And it's going to go down maybe 6%. But it's still going up over the long run. And then it's going to go up. And let's say it's going to go up 15%. So if you're holding on to it, yeah, you're still going to get the 10% per year on average. So what is dollar cost averaging? To explain it lightly, let's say you make 5 grand per month. And out of your 5K per month, which by the way, you don't need to make like 50 grand a month or 5 million a year to do dollar cost averaging, not at all. You just find room within your budget. So you can invest $100 per month or $1,200 per year. What you do is just set up an automated invested. So every single time you have $100, it just invests into your investment of choice. What this does is even if it's going up, down, and up and down, you're buying at every single point along the way, and your cost basis, which is the average of your position, is going to remain in the positive. Hopefully, as long as you're in good companies. I understand things happen, but this is how people do good over a long run investing. So that is the basis. And so if you hear me say DC8, that is what I'm talking about. So if we look at Palantir, oh my goodness, 23% drop in a day. Sounds crazy. Since 2020, Palantir has had 10 drops of more than 20%, meaning this is not the first time. It's far from the first time. Even crazier, February 2025, Palantir dropped 50%. So exactly 1 year ago today, essentially dropped twice as much as it just did now. And people are freaking out over 23%. And in 2022, it dropped 83%. So you might be wondering, so why even invest? That sounds really scary. Why not just keep your money in cash? And this is the reason why. Palantir, since 2023, has gained 2,200%. 2,200. I don't know the math on that, but if you were to invest 50 grand into that, you'd probably have over $1 million for sure, okay? So when you look at these scary numbers where they've had drops, these drops are just normal. Don't let that scare you or shake you out of your positions, which is a big thing that investors often have happen to them by these large institutions. So how do we control the want and desire to leave your positions, especially when you're hearing on social media, a bunch of fear, the world's going to end, you're going to lose your job and never find another one? Here's the first step. When there's drops, it equals emotional trading. This is exactly what we don't want to have happen because emotional trading leads to mistakes. Have you ever met someone who's emotionally traded and made a great decision in their trading? I haven't. And this is exactly why. When you're getting too emotional, you have to step away. And then remember, when you're dollar cost averaging into long-term positions, it generates wealth. And that's ultimately what we all want in investing in the stock market, to leave our 9 to 5 and to do this passively and to spend time with the ones we love. So this is exactly what I teach. So how can I keep control of my emotions? When you're in a group of members and they're all going through same fears, you can say, all right, now I understand I'm not alone in this. I can control my emotions by thinking of something else, understanding this is a normal statistic in the market. I have to keep investing. And in fact, I should probably invest more. Every dollar you have, put it into the market when there's these drops. Because if you look back at 2022, when we had a big sell-off, if you're not familiar with what I'm talking about, that's totally fine. But in 2022, when there's lots and lots of sell-offs in the positions, if at that point you invested more, you'd be totally great now. You would not be at all complaining because your cost basis on your position would be so much higher or would be so much lower than what these companies are actually worth nowadays. And that's the main piece behind emotional trading. You have to remove this. You have to completely remove it. If friends are freaking you out, stop talking to them about stocks. If your boss is telling you what to do with your stocks, stop talking to your boss about it because you have to remove the emotions. It will remove the mistakes and then you just keep doing what you're doing long term. Okay. Another piece to this is we don't look at price volatility for that reason. So when we go back to learning about the DCA method, like let's say this was 110 and this was 115, 125, 140. This is back to 127. This is like 116. Okay, we don't look at the daily averages. And the reason why is you're thinking too small term. We don't look at the dailies. We always look at more of the long-term growth profitability of these companies, which is why we did our analysis if this is a good company in the first place. Now that we know that, now when there's dips, it doesn't freak us out as much. So the daily price fluctuations shouldn't matter to you. It doesn't for me. You have to keep the emotions out of it. So why not just sell everything and keep cash on the side? Like we just went through, hopefully you understood that. The 2,200% increase in Palantir over the past few years since 2023. Absolutely amazing. I definitely don't recommend keeping your cash on the side, but there is some positives to this and we will dive through them. Positives to keeping cash on the side is it feels safe, feels, not is, feels. And then there's also peace of mind when you are sleeping at night, knowing that I'm not going to wake up and have a $50,000 paper loss on my account, even though it's not a real loss until you take the loss. Those are about it for the positives I could think of. The negatives are massive. And it's inflation. Back in 2022, if you had just kept cash, then think of how much you would have lost by not investing wisely. You would have lost so much money. I don't know how much your portfolio is, but most investors would have lost hundreds and hundreds of thousands of dollars from their 401k and IRA and their different retirement accounts and brokerage accounts. So please stay invested and then let the gains obviously compound, which goes into this one for your portfolio. And then always looked. And then a big piece is that you're locked out from the upside. Now, what our brain tells us when there's a positive upwards trend in the market, our stocks are going up, we're seeing that we're making money, it's exciting. Our brain's saying, perfect. There's not a lot of downside. I'm making money. This is great. And the opposite is true when there is a correction in the market. Our brain says, oh my goodness, you should sell everything. This is terrifying. Guys, please do not exit your positions unless you're in a terrible company and you're fine to take a loss, because this never works out the way you think. You're locked out from the upside. And so what happens is you'll exit near the bottom, just like that example we showed you. And then you're going to want to re-enter at the top. And then the cycle just continues for a long, long time until you realize that you're the problem with your trading. So if you're tired of selling at the bottom and buying at the top, you could consider joining the group. I'm launching it pretty soon. And then you could figure out if you want to obviously master your skills. So ultimately, being invested is safer over the long run. And then look at the market since 2020. The S&P 500 has absolutely exploded. You can see here, this is just a basic Yahoo Finance. Okay, so back in, doesn't even go that far back, but we'll look back here near 2021. This is February 12th, so $135. If you did just dollar cost average through there, I mean, you'd have a fantastic position. And then up near, it's about 270. Today, it's about 278, okay? So 278 from 129, so you have about $150 spread over 5 years, which is pretty good. So you'd have doubled your money and some. So if you've invested 100 grand into Apple stock, kept in there DCA'd, you'd probably have a little bit over, I'd say about 260, 270. If you would have sat on the sidelines, you would have probably, your 100 grand would have probably turned into not too much. It'd probably been near. If you would have left your cash on the sideline, your 100 grand would probably be worth like 70 grand, maybe even 60, 65 because of the inflation, which is obviously chipping away at it. I think the national average is like 2.9% for inflation, which obviously I don't know if that's legit or not. It's probably more than that. It's probably 4 or 5%. So it's always good to know. So this is my DCA system. Very simple. We buy good companies at the fundamentals. We don't buy penny stocks. We don't mess around with day trading. We buy good companies for a long term, and that's how we make money. It's very, very simple, but it's harder to do in practice than you think. The second piece is self-control. So now that you purchase the companies, so you put your money into the companies, now we have to let it sit and we have to have self-control. We have to ride out the storms, control our emotions. And then the third one is buying below the threshold. And what I mean by this is obviously when you are talking DCAing, you're obviously going to keep your money invested over time, just, buying all those little sections around the DCA in the positions. But when there are dips, like there is right now, instead of freaking out, actually look to purchase more on a great company. So this is kind of a support line here, okay? So when it hits these points, let's go ahead and purchase more. Let's like liquidate all the assets and take out a home equity line of credit. No, I'm not talking about that. I'm just talking about in your budget, whatever you have left over, just buy some more. So we're going to buy here, just like we put right here. I'm going to buy. What this will do is help out our cost basis over the long term. Because instead of $100 being our average cost basis, actually this example, bear with me. Instead of our average cost basis being 100, it might be 80. And then the stock, like we looked at right now, is at about 278. You have a really, really good cost basis when there's dips and you're buying more. And that is my system. If you guys enjoyed this video, consider giving it a like, subscribe. There's lots more videos coming out pretty soon with Palantir. We have some exciting earnings to go through. I'm super excited to walk you through it. And just consider, and we will see you guys next time. Take care. Peace.